All right, hi guys. Welcome to part two, where we discuss the basic structure using various different time frames, asset classes to understand how Wyckoff works in real time. All right, so we're actually looking at an asset right now, and this is dollar yen on a 15-minute chart. Okay, so this is a currency. Again, for guys who are familiar with FX, you'll immediately start to enjoy this and get to grips with it. On the same side of the fence, if you are more of a stock trader, and bearing in mind that this specific course has actually been done with stocks in mind as well, and also commodity traders who are not using market profile, right? And again, guys, if you want to learn about market profile and you're hearing this for the first time, we have a course on market profile, which is time price opportunity. So check it out. And we also have a course on Elliott wave as well. So and that actually marries in very nicely with Wyckoffian logic. So again, and when you see me work with giving you some practical examples of managing your trades, then you would actually understand what I mean in terms of Elliott wave's relevance to Wyckoffian logic. And what you'd find is actually these people, they existed within the same sort of timelines. Now, Elliott was more the early 1920s to the 1930s, and Wyckoff was more the early 1900s, and the late 1800s. So, very close in timelines, but the reality is that most of these guys are within the same period. So you find that ideas and strategies are relatively very, very close, and some of them have better ways of doing things than others, and it's nice to be able to take that on board. Now, there's no right or wrong in investing. It's about having a strategy that works in terms of how you manage your positions, and you'll be able to handle your risk from a very comfortable, relaxed perspective. And that's what we try and do here, is try and get you into that place where you're relaxed and you can handle your investments and you're very confident about it, right? So we're going to talk through the different structures, right? And then we're going to go a little bit more in depth in terms of analyzing the accumulation area, right? So the basic structure is we have accumulation, right? Which is, from this perspective, I'm on a 15-minute chart. It looks quite small. If I was to put this in a 1-minute chart, you'll be able to see more tests, etc. But what we've got here is our climax point, and this is our secondary test, and this is our LPS, or last point of support, and that makes up the accumulation area, and then we take off into the markup phase. So most traders who are already familiar with Wyckoff would have already identified this as a very good trading opportunity within a 50-minute time frame, considering we had been distributing prior. So this is not really that complicated or difficult to get your head around, right? And again, we'll talk about the finer points as to how you identify this as accumulation. And then we break into a markup, and then we start to distribute. Okay, as you can see, there was a distribution, and then that's went into what we call a reaccumulation. Now, it doesn't always look like that. What you'd find is that some people prefer to teach it as accumulation, markup, reaccumulation, then distribution. But like I said, that's a linear way of looking at things, and a lot of people are linear. It's partly due to our Western education systems, which have taught us in a very linear fashion. We've been taught that one thing leads to the next, right? And as a result, we need to see a step-by-step approach. Now, I'm sure all of you have heard people use the term step-by-step approach, right? They do not like words like dynamic approach, because dynamic feels like I'm so confused. I want a simple step-by-step approach. The fact of the matter is that there is no simple step-by-step approach. What we have is a dynamic approach to trading and investing, which means that you are going to have to be dynamic and think a lot more about what's going on around you, and expect that multiple things are happening at multiple times. Now, bearing in mind that the whole world are not 15-minute traders, okay? There are traders who are trading on 4-hour charts, 1-hour charts, 1 day, 1 year, and we do not know when they're going to act. They might be acting right now in very large quantities. So the reality is that whatever algorithm is now making the market has to respond to all these different participants at these different times, but all happening at the same time, right? So what we have is a scenario where we've got accumulation, markup, distribution, and that was fine for 15 minutes, and this is an actual distribution. But then a larger player steps in, right, that is now willing to take us into a next stage of markup. a reaccumulation begins. It's very quick, it's very rapid within the 15-minute, and we get a much larger markup cycle. Now, if I was to push this into, say, a 30-minute or 1 hour chart, then what you will see is a lot of this finer detail will disappear, and then we'll be referencing a much larger move. And an Elliott wave practitioner, for example, might observe this as an ABC cycle, right? Or some other kind of trader might look at this as an AB equals CD type cycle. So the truth of the matter is that we are technically seeing relatively the same thing, but our observation is very different in terms of what we're using to determine what action we take, right? So the truth of the matter is that we do not get a smooth cycle of accumulation, markup, reaccumulation, and distribution and redistribution. What we get is a cycle where we go accumulation, markup, and distribution within one time frame, and then all of a sudden another time frame steps in and controls the market and then recreates a reaccumulation just slightly under that distribution, and then we go into a new markup phase, and then we start to distribute again. Now, depending on whether this distribution is going to be a more long-term distribution or more long-term cause, then we might see this market dropping way back down again into the reaccumulation or accumulation zone. So this is obviously now looking ahead at the future. This is a live market. It's a live 15-minute market, but we don't know what's going to happen. So we have to act on our market based on these principles. So as we drive in, right, we start to make different observations as the price action develops. So this is actually distribution, but then on the flip side, this might build up into a larger form of accumulation moving forward on a higher time frame. So it's just being aware that the markets are not linear. They are cyclical in nature, and they operate in a very dynamic fashion, which means they operate on different time frames at different points in time. Okay, so it is not a simple arena, and if we try and oversimplify it, beyond a shadow of a doubt, we're going to make a few mistakes. Right, so this is one example of the basic structure. Now let's take a look at an example coming from the top down, just reflecting that cyclical nature. So this is British pound sterling on a weekly time frame. So as you can see here, we have a type of upward distribution that was taking place, and that eventually led to a markdown and a redistribution, which actually lasted 5 years and then continued to redistribute. So within this redistribution, there would have been accumulation phases as well as distribution phases as the market develops, and then eventually we came down. But if we looked at it on a longer time cycle, we would have realized that we were actually in a redistribution phase. And I'll tell you why you would consider this a redistribution phase, and this will take you a little bit into Elliott wave. And it's a very, very good guide when you actually start physically trading with Wyckoff to use that as a marker. So if you, well, and we'll discuss this in a little bit more detail as we get into another course, so another part of the course. So in effect, that's what we're looking at. And I guess now looking at this, it makes sense to everybody why we're seeing pound sterling rising right now as we entered the final markdown, which took us back to 2016, right? So for most people, it's not strange to see the pound rising, and I have no doubt in my mind that we will eventually develop a trading range, and we will start building on pound sterling. And since this is happening in a much larger cycle, we can actually go into a much smaller cycle to visualize the behavior of pound sterling. So you can see here distribution, markdown, redistribution, and final markdown. So again, this is just another sequence in the cycle, and that I didn't show you guys in dollar yen because that was actually absent. But as you can see, this has taken a slightly more linear approach over the longer term. But again, we must not get into the habit of thinking the market is linear. So we've seen here distribution, markdown, redistribution, and final markdown. This is very linear. So one thing has led to the next. But in most cases, if we looked at pound sterling over maybe a 5 or 10 year cycle, then it might show you a completely different picture, right? So it's just something worth bearing in mind that there are things happening over different time frames. So we should try and abandon that mentality that everything is linear, right? So hopefully this you've enjoyed this section of the course as well, because I wanted to give you guys an overview of what it looks like on a chart, because when we often talk about these things, we don't exactly get to see them on a chart because yeah, it's all good. When you have to act on this stuff, it's a little bit different, right? And being able to understand the differences, the dynamic differences between The fact that we get a linear setup like this, which is what you will get taught because it's a perfect setup, but also be able to visualize what was happening at these different points in time, because this is not quite a straight trading range. What we have is just restricted topward price action, but this is all distribution, and you will see me explain that in the other sections of the course. Again, this is a much smoother trading range, right? So this is more flat and horizontal trading range, and we have nice redistribution, and we have a nice sail under the ice into the final markdown, and this is picture perfect, right? But then when we go to look at our dollar yen example, far from picture perfect, because what we have here is overlapping time frame activity. So we have accumulation, markup, distribution, which seems perfect without the reaccumulation and redistribution in the middle, and then we start to reaccumulate at a lower base, right? And this is very, very strange, because you'd easily want to regard this as a new accumulation, but the fact is it is a reaccumulation, because we're still above the overall accumulation area, and that puts us into a stepward action into a new markup phase. So you can actually identify that there are unique differences between these two modes of operation. Awesome stuff, guys. See you on the next course.